Hi there, this is Tyler. Welcome to the Stockscores Market Minutes for November 16th, 2015. Before I get into this week's topic of the week, I want to remind you that I have 3 webinars coming up this week. Tuesday, a webinar on day and swing trading, how I do it. Thursday, how to grow your retirement portfolio. And then the following Tuesday, how to trade the Stockscores approach. These webinars are all free. You just simply go to stockscores.com/webinars to register. Register for one, register for all. And anyone that registers will get a link to the video that you can watch later as well. All right, let's talk about this week's topic, which is making money from weakness. In the analysis that I show you in a moment, I think there's a very real chance that the market is headed into another downward move here. We saw that begin last week. I'll talk about that in a moment. So, how do you take advantage of it? There are many traded instruments that you can use to profit from market weakness. There are inverse exchange traded funds, sometimes they're called exchange traded notes, like the SH, which is the S&P 500 inverse ETF. SDS is the same as the SH, except that it is leveraged. It's double the, it will do double the move. So if the S&P goes down 1%, SDS should go up about 2%. QID is based on the NASDAQ. The VXX is the volatility index for the S&P 500 futures. I love to trade this during market corrections. UVXY is a leveraged version of that. In Canada, there is the HIU and the HVU. The first is based on the index and the second is based on the volatility of the S&P 500 but priced in Canadian dollars. So there's lots of ways to take advantage. I haven't even listed them all. There's many more. But it's important that you understand how they work. The leveraged ETFs get rebalanced every day, and that effect over time can cause some value decay. They're more of a short-term instrument. Now, if you want to understand how that works, just do a Google search for value decay of leveraged ETFs, and there's lots of people that have put out videos and articles on how that all works. I want you to understand that before you trade these things. I love to trade these things during times of market correction, and because I think that's a very real chance, I think you can make a lot of money in these vehicles over the next little while. All right, let's take a look at my analysis for this week. You can see that the short-term upward trend line on the S&P 500 index was broken on Monday, basically. We had a breakdown, and I became very cautious on the market that day. And inevitably, you get a little bounce back rally. We had that for 2 days. The market came back up to the red downward trend line. And then Thursday and Friday, heavy selling. The market's a little oversold in the short term. It wouldn't surprise me if early next week we get a bounce, but I think there's going to be lots of volatility going forward, and so you want to be very cautious with U.S. stocks. Trade the VXX. The inverse of the VXX is the XIV. You can ride the swings up and down with those two instruments very well. So keep an eye on that trade for next week. Now here is the, I think, the critical chart. This is the chart of the S&P 500 ETF. This is a 5-year weekly chart. I've drawn in green the long-term upward trend line. Now we had the correction in August, and it basically came down to that trend line, actually went through the trend line during the week, but came back to close above the trend line. And you can see that we closed above the trend line every week, although we did have some intra-week moves below it, that green line there. Well, at the time I warned that the market, if it rallied back, if it had a bounce, what we had to watch for was whether there was a falling top that would form. Well, look at the current week, which is the red candle on the right-hand side of our chart here. So that's this week's trading action. It was the worst down week since August, I believe. And so notice that that breakdown comes from a falling top. This high is lower than the previous highs in the summer. And that tells me that the sellers are picking up momentum. Now, we haven't broken the long-term upward trend line yet. We could have another ugly down week next week and still hold that upward trend line. But if we get a significant close below this green line, that points to a likely bear market in stocks. In the short term, I simply think that it's a trade where we get a little bit of a correction over a week or two, and maybe we bounce back and hold and trend sideways for a while. That's, I think, the most positive outlook I have for the next few weeks. The negative is that in the next few weeks we actually break that long-term upward trend line. So I am bearish on the U.S. market right now. I want you to be cautious with it because of that falling top. It's not critical yet because we haven't broken the upward trend line, but certainly as a short-term trader you can take advantage of this weakness. Here's the Russell 2000 Index Fund, IWM. It broke its upward trend line and then tried to bounce back. Actually looked like it might rally, not last week, but the previous week, but it gave back all those gains this past week and is flirting with that upward line of support that I've drawn, the short line I've drawn in green. So again, a lot of cause for concern in the small caps. Certainly not as risky as the large caps because the large caps have risen so much more. You can see the small caps have been pretty much sideways for 2 years, and so not as much risk there, but it does look like they may feel the brunt of some weakness as well. Here's the TSX 60, which spiraled lower over the last couple of weeks. You can see we're in a pretty strong downward trend on the intraday chart. I think if you haven't sold your stocks in the Canadian market, you probably want to sit on them still because I do think there could be a little bit of a bounce back in the short term. This market is a little bit oversold right now. It's gone down for quite a while, but it's a bearish chart. I mean, let's call it what it is. The tops are falling from left to right, and that means the sellers are in control. So now that's my short-term outlook. Longer-term outlook, notice that we had a breakdown from a pennant pattern this week on the TSX. So this is the 3-year weekly chart. This is the current, this last week right here, which was a breakdown from the low volatility sideways pattern that the market had been in for the last couple of months. So the the downward trend line has held, and the short-term upward trend line, which had been slowly building some optimism, trying to stabilize the TSX, broke down this week, and that points to lower prices ahead. Not necessarily in the next week or two, because I do think this market is a bit oversold and you could see a little bit of a bounce back, but I would look at that as an opportunity to lighten the load on some Canadian positions if you have them. TSX Venture, been a dismal market for a long time. You know, I keep hoping that we're going to stabilize and break higher, but we just can't break the downward trend lines, and that has occurred again this week. The downward trend lines remain intact, so remain bearish on the TSX Venture. Treasury bonds in the U.S. Broke down 2 weeks ago. That meant that interest rates went higher. We actually stabilized a little bit this past week. As markets sell off, oftentimes you'll get a little bit of a rush to safety. That means money moving into bonds, and I think that propped up the bond market a little bit last week. But the outlook for U.S. bonds is still for lower prices, which means interest rates rising. Interest rates rising is positive for the U.S. dollar. It makes it more valuable to own the U.S. dollar if you can get a higher interest rate on U.S. denominated debt, and so the U.S. dollar has been moving up. We called that a buy 4 weeks ago, and I don't see any reason to reverse that outlook. I think that the outlook for the U.S. dollar is bullish. Again, in the next week or two it could pull back, but looking out longer than that, it looks to me like the U.S. dollar is going to go higher. That is a negative for commodities. You can see the effect it has had on gold. Gold now at new lows and remaining in that downward trend. And oil broke down this week. It was actually holding up pretty well, but this week it rolled over and is now going to test those lows of August. So that's a cautionary thing. We may hold support, but you know, this market, it actually broke its downward trend line 6 weeks ago, and I thought we might be at the start of a reversal. But as so often the case, momentum rules, and the buyers still can't gain any foothold in this market. The sellers are in control. The volatility of this week caused the spike in the VXX. You can see it moving from $19 to $22 in just 2 days. That's a pretty good move, and I think that that could continue. I want you to focus on trading the VXX and its inverse, the XIV, because you will get gyrations up and down. It's a short-term trading vehicle. I think you have to be a pretty savvy trader, but certainly that is a place to look for some opportunity. So I'm bearish on everything. U.S. stocks, Canadian stocks, gold, oil. I do think that the selling pressure next week could bring in some sucker buying early next week, the selling from last week rather. But I want you to be careful because I do think that there's some pretty negative signals in the market about what's going on. You know, this week brought back the sellers to U.S. stocks, breaking the 6-week upward trend and forming a falling top on the weekly chart. Watch for a retest of the long-term upward trend line. That's the 5-year trend line on the S&P 500. Commodities are back to suffering after a short period of stability, keeping the Canadian market in the grips of the bears. Well, that has been the Stockscores Market Minutes for November 16th, 2015. Have a great week in the market and trade well.